Rolling options. It's a little bit trickier than one may think. It's not as simple as just closing an old position and opening a new position, yet that's exactly what you're doing. But there's a lot more that goes into rolling options. It's not just as simple as rolling from one contract to the next contract week in and week out because the price of the stock hasn't hit your strike price. Rolling options is actually an art because there's a lot of times that you're going to be selling a covered call and the stock price is going to go above the strike price and you could get assigned, and that can be scary. Well, my strategy allows you to avoid that if you don't want to lose your shares. So we're going to dive right in. Hey guys, Corey here. Welcome to the channel. If it's your first time, be sure to subscribe and tap the bell so you know when I post new videos. And not only that, give me a thumbs up as it greatly helps the channel grow. High five. We're making money, everyone. Upstart, Hims, Rivian, Soundhound, Palantir, the list goes on. If you want to make juicy premium and profits like we have been, join the newsletter. It's free right there on the screen, as well as in the information box below. There's a direct link. For the first 100 people that sign up, you're going to get my personal tips and strategies, technical analysis, fundamentals, and financials delivered right to your email. But not only that, the first 100 people that sign up right now are going to get free trade alerts. Let's go. Sign up. High five. Let's make some money. Another thing I want to point out before we get to the video today is that in about 2 weeks' time, I'm launching my Discord and my full course. So if you guys want to learn the same strategy I've been using that took me from 13,000 to 7 figures and just a little over 4 years, I'm going to be teaching it every step of the way. So if you guys want to be coached, mentored, and learn how to trade, become consistent and profitable, and maybe even someday quit your job and be able to do it full time, that is my goal, is to teach everyone my strategy. A very limited number of spaces available for you guys to sign up. So you might want to sign up as soon as it's available. In about 2 weeks, I will send out emails to let you know. So whoever signs up for the newsletter and also emails me, Corey@investwithcorey.com, or reply to the autoresponder when you sign up for the newsletter to let me know you want into the course immediately, I will let you know right away. Let's dive right into today's video, and that is rolling. So if you have a covered call, you're selling a short call, let's say it's $35 and the stock price goes to $36, you could get assigned. You have to sell your stock for $35 at the strike price, even if the stock goes to 70. It doesn't matter. And a lot of the time this confuses traders because they will see, and a lot of traders will be confused because they'll see that their contract is in the money, and then they try to roll out to the next week or the week after, but they can't do that because of how expensive the option that's in the money is. And there's a way around this. However, it's a strategy that I've been utilizing, and it's a little tidbit from my 5 years in the stock market. The only thing is there's a trick to doing it, and you must have patience in order for this to work. And I'm going to explain everything to you guys so you can understand. Let's dive right in. Now, I'm not a financial advisor, and this is not financial advice. I'm just giving you guys technicals, fundamentals, financials, different strategies to help you become more profitable. However, it's ultimately up to you to decide which stocks you want to put your money into and what size of a position that you would like to have in that stock, as it's your money. Okay, guys, I got a small position in Robinhood on this portfolio specifically to show you guys how to become profitable and how to roll covered calls, sell puts, get in and out of stocks, run the wheel strategy, and just make profits. I have almost a similar situation in my large portfolio where I have 2,000 shares of Robinhood. And in fact, it's a little bit worse because I'm deep in the money on 3 short calls over there, and I'm having to roll out a lot. It happened over here again. This one, not as bad. On the other account, I've got $16.50 calls that are deep in the money. This one here is $17.50 calls. So I purchased these shares because I knew Robinhood was going to be going up, and I'm already $700 in the positive, and I didn't buy these shares in this account until, you guys will see, May 10th, because I knew it was going to go up. So it's only been 1 week and I'm already up $700, and that's a lot of profit. 3,300 into 4 grand. So this is like a 20-something% return in a week. However, I sold covered calls and lost money intentionally so that I could show you what to do in this situation. My intention was I wanted to buy Robinhood, ride it out till it goes to $20, $22, sell it for a full profit, which I'm doing in my other account. However, on this account, account, I specifically use this account because it's smaller, less risky, and I use it to show you guys realistic trades and what you could do in a realistic scenario. Because let's face it, a lot of these traders on YouTube, they have $1 million account and they're like, oh, it doesn't matter. I got 10 grand worth of Palantir or SoFi or Robinhood and I'm $900 to $1,000 in the hole on 2 contracts. I'll just buy to close them and then I'll sell some calls weekly for 3 or 4 months and make my money back, or I'll just go trade somewhere else and make money. That's not realistic because you guys don't have $1 million. So for me to pull out a portfolio with $1.5 million and say, oh, well, I lost $300 on 2 separate call contracts. It's only $600 in calls. I'll just buy to close them and move on. That's not going to teach you anything because it's not realistic. So I intentionally created this Robinhood account with $2,000, or actually it's like $1,500, and I wanted to get it to $14,000, which I did as a challenge. And I'm going to explain all that in my course as well. But for the YouTube, I started this specifically so I would have a portfolio to trade realistically on. It's not realistic for me to start trading on my $1 million account and for you guys to be like, oh, well, I mean, he ran into a $5,000 problem, but it doesn't matter. That it's not going to help you guys. So this account, more realistic. I got 200 shares of Robinhood. I bought them. I sold $17 covered calls when it was $16.50. I knew it was going to run up, pinned me deep in the money with the $17 call. And that's exactly what I wanted to do because I wanted to show you guys how to make this trade. So like I said, instead of trading on a big account, trying to make lots of money and make it look easy, I'm trading on a small account, losing money to show you how to get out of this situation because I wanted to sell $20 calls, but I did 17 so that I could legitimately give you guys a real world example, which is why it's taken this video several weeks because I've been looking for a candidate and an opportunity to get a covered call deep in the money so I could show you what I would do. So here we go. Now I've got my situation. I'm not worried about it because I'll recover it. It's just going to take me 3 months. All I really did was put my money out there for a couple extra months. It's not a big deal. This way I could show you guys how to fix it. So I bought Robinhood here at $3,300. It's now up to $4,000. I could have made $700. However, I sold $17 covered calls right here, 2 of them for $56. Now, realistically, I could have allowed myself to be assigned because I would have made $100, $50 on each 100 shares plus the $56. So I was up $156. However, I feel like Robinhood's going to come back down to the $18 range when the meme rally's done. And I wanted to show you guys, of course, how you can roll out of a deep in the money situation. Rolling covered calls is pretty easy. I did it here on Nike and got $25 more. And what I did was buy to close the old one, sell to open the new one. I'll show you guys the history. So I got $25. I also got $18 here. So what happened is I sold this 93 call for this Friday and I sold it last Friday, collected $53. Nike went down. So I closed it and sold a 92 for this week to follow the price because when the price starts dropping, you can roll down as long as you're sure the price is not going to go back up. So I did that. I collected $18. Then when I saw that Nike was approaching $92 and it actually went over $92 by like 10 cents, I bought to close the 92 contract for $8 and sold the 94 for $33 and collected $25 juicy premium. Now, this is not that hard. You're just basically buying to close, selling to open. And when a stock price is within, I don't know, 10 cents, 40 cents, maybe even 50 cents of the strike price, as you get to 3:30, 3:45 p.m., there's only intrinsic value left. So typically it's $20, $30. If that was the case and it was $30, I would have just sold the 95 call, which would have got me the same money because in order for the price to be higher on my 92 call, the price would be deeper in the money. So that contract was worth $8. If Nike had went from 92.10 to 92.50, then obviously the 95 call contract would have went up in price the same as the 94 did. So I still would have got $20 to $25 either way. However, when these contracts are deep in the money, when I say deep in the money, I don't mean 10 cents or 50 cents. I mean like $1 or $1.50 or more. And usually more than $1.50 because even $1 not that bad, but $1.50 in the money, you got to find a call to roll to that's over $1.50, which means you have to go out a while. Let me explain how to do that. This is an art. So what I did with Robinhood is I rolled out 2 contracts for $38 credit. I went out to June 28 and collected $38 more. Look, I was going to get assigned at $17 no matter what. So I don't need to roll up to $18 because that puts me out several months. You never want to cross the 6-week barrier because then it takes like 30 days of rolling to make up for 1 to 2 weeks. Once you get past 30 days, you'll find out that you can roll out another 30 or 60 days. It makes almost no difference. So what I've done is I've went to the 5-week window and I've rolled from a $17 call to a $17.50 call while collecting $38. If I get assigned assigned early, then that's fine because I collected an extra $38 and I'll be assigned at $17.50 instead of $17. So I'll make another $100 plus the $38. So to go out to June 28th, which is 5 weeks, essentially I'm making $138 more for those 5 weeks. Then when those 5 weeks are up, all of the extrinsic time value on these contracts will be gone. I'll be able to roll out 5 more weeks to the end of July and up to $18. All the while, Robinhood's probably going to come back down a bit and be in the $18 range, and then I can recover not having to sell my shares. So if you're asking, Corey, what is happening here? Like, how did you do this? Or like, I don't get it. What am I supposed to do? Well, it's simple. If you have a $17 call on Robinhood, let's say, just like I did, and the stock price goes to $17.50, well, then you roll out 2 weeks and you roll up to 18 and then you're good. But it's not the case. If the stock price is $20 and your strike price of your short covered call is 17, these contracts are worth $300 each. In order to make $300 on a covered call, you have to go out like a ridiculous amount of time, which is 5 to 6 weeks. The thing is, implied volatility is usually greater on expiration, meaning you have to make up for implied volatility being higher on the contract you're getting ready to be assigned on versus the one that's 2 to 3 weeks out. So you have to use time, theta, to make up for the volatility and the assignment and the high price. So we can't roll from 17 to 19. I'd have to roll out to September, which I could do because I don't think Robinhood's going to be going to $20, $25 that quickly. And if they did, I would just roll out to December and go up to 24, and eventually I would catch up. The idea was to show you how to collect premium while saving your assignment and making more money from the assignment. So you got to have the mentality that I'm getting assigned. Oops, I sold a covered call for 17 and the stock price is 20. I'm getting assigned no matter what. How can I do damage control, possibly save my stock and make more money in the process? Well, it's simple. Theta. We use time value to prevent us from getting assigned. So there's a good thing. And then we roll out just enough with a similar or the same strike price to delay the assignment while collecting more premium. I could have rolled out $17 for June 28th and turned this into $100 premium. But when I rolled out to $17.50, I'm already making $100, $50 more per contract plus 38. So I'm making $38 more while slowly encroaching on a higher price because I feel that in the next 2 to 3 weeks, Robinhood's going to come down a little bit. So it's going to be somewhere in the $18.50 range when this expires. And then I can roll from $17.50 to $18. And then by July, we'll be somewhere neck and neck. They'll be like right beside each other. We'll be at the money somewhere. And if we're still out of the money, I can just keep doing this. Now, if you don't mind getting assigned at 17, then you could roll out 5 weeks, collect 100, roll out 5 weeks, collect 80. And what you're doing is you're putting yourself on borrowed time because you could be assigned at any time, but you're just collecting a bunch of premium in the process. In the United States stock market, you can be assigned at any time. However, it's only happened to me twice, once with Palantir recently and once with another stock about 6 months ago. And it hasn't happened since or in the last 5 years, really. Like that's it, twice. So that's not really a big thing to worry about. The issue here is that we have to understand the fundamentals of selling a covered call. So let's look at the call that I currently have. You can see the stock price is $20. If I go to my $17.50 call, you can see that it's worth $3.10. $17.50 plus $3.10 is $20.60, $20.60. Well, the price is only $20, which means there's $60, 60 cents times 100 shares, $60 extrinsic value left. There's only $2.50 intrinsic in the money value on this contract. So no one's just going to exercise it because they do that. They're just taking $60 and burning it at the stake. It makes no sense. And almost, if not nobody is going to do that. So until I see that there's no extrinsic value, I'm not really at risk of being assigned. And if I get assigned, I'm $50 per contract higher than I was. So instead of letting myself get assigned for $3,400 and making $156, I'm now going to make that same $156 plus the 38, which is now $194 plus the extra 100, so $294. I've now doubled my money, and all I have to do is wait 5 weeks. If Robinhood falls below $17.50, then I'm good. It'll expire worthless, and I can keep selling covered calls. I get to keep my stock because, in my opinion, Robinhood will be probably closer to 40 or 50 in the next year or two. However, that's a discussion for another day, but you guys can see how this works. Hopefully you guys are following along. So worst case, I get assigned. Okay, well, I bought the shares for $16.50 and I get assigned at $17.50 instead of $17. So I'm making $100 more plus the 38. So $138 more. And if I get assigned next week, I only had to wait a week to make $138, or $138 and wait 2 weeks. But if I don't get assigned by the 28th of June, the premium's mine and I can roll again. And this time it's going to be another $30 to $50 for another month to go up to $18. And there's going to come a point where the stock's going to fall below the strike price and I'm just going to keep collecting juicy premium, because this is a long game. By December, I'm still going to have these shares 90% chance or higher, and I'll have made somewhere in the neighborhood of $300 in covered calls because of this, example. But if this hadn't happened, I probably would have made more or less $800 in covered calls. It's hard to say exactly, but either way, I'm making money. Like, even if I only make $400 by December, that means these shares only cost me $12 instead of $16. This is why the art of rolling is so powerful. If you understand the art of rolling, you can make all kinds of money in the stock market. You just have to be patient. For example, if I was going to roll this position, I'd have to go out to August to make any real money, or July. But I could roll to August and I could roll up $18 and collect $136 juicy premium. And now I would be out to August, almost 2 more months, but now my strike price would be 18 instead of 17.50. Or I could go up to 19, which would put me at $46 juicy premium, which I'd rather do this. This way, I'm at $19. It's still in the money, but it's a $340 contract and it only has $100 worth of intrinsic value. So there's over $240 of extrinsic value. This would eliminate the assignment. So next week, I'm going to do another video and probably roll this contract to July or August, because it's another $46 premium for me. And I'm showing you guys how to do this. Now, let me show you one more trick that will help you become a master of this art. And this is part of how I handle covered calls. Let's go back to my covered call on June 28th. Here it is right here. 2 contracts. So we can see that I have a theta of 0148, which is $1.48. Every day, $1.48, they decay. So let me show you guys how we would figure out a roll to August. This is how you figure out value. We already know that my June 28th contracts have a theta of $1.48, basically $1.50. If we go out to September on, let's say, an $18 or $19 contract, they're $1.30. So they're 20 cents per day. And theta changes as you get closer to the date. The June contracts will increase in theta the last week. So we have to calculate the theta. So what we're going to do is, from now until the second week of June, it's going to lose 70 cents a day versus this contract. So from where the contract is right now until the first week of June, let's say June 7th, that old contract that I'm running, the June 28th contract, is going to lose 20 cents a day in comparison to the September contract. So we looked at theta on the old contract, $1.50, the June 28th contract. And what we're going to do is we're going to subtract the extrinsic theta value on the $19 September contract, which is $1.32, leaves us with almost 20 cents. We're going to round up to 20 cents. So for the next 21 days times 20 cents, my contract I currently hold is going to decay by $4.20 each contract. Meaning on June 7th, if I click on roll to this $20 contract, you can see I'm going to get $22 credit. Well, now I'm going to get $4.20 more per each of my contracts. So this won't be 22, it'll be 26 plus another 4, 28, 30. This will be a $30 contract because we're taking the $4 for each contract. That's $8 added onto this, because the June 28th contract is decaying 20 cents a day more than the September one. And the last 3 weeks, theta increases, which I'll show you by going to a May 31st or 24th contract next week. The $20 contract has now got a theta of $6. So from June 7th to June 28th, the last 3 weeks, we're going to average a $5 theta. Even if we go out to the 31st, we can see the $20 call is $4. You see? $4. So the last week is $6 a day. The second last week is $4. And the third last week is $3. So we're going to have 7 days of $3. So $21. Then we're going to have 7 times 4, 49. Then we're going to have 7 times 6. So from June 7th to June 28th, there could be relatively between $70 and $90 decay depending on the volatility. So we're going to play it safe and say 70 plus the original $4. So we're going to have $74 times 2. So there's going to be about $148. So there's safely going to be $140 to $150 in decay. So when I go to September, click on this $20 call contract, $22 credit. This is going to realistically, if the price is staying the same at $20, realistically, I'm going to collect $172 credit to roll up to $120. Now, it's probably going to vary on volatility and things like that and how much theta. And if the theta doesn't go up as high as it has been, then there's a chance that, you know, we might only get an additional $100. This will be $122. If the price goes up, it's the same thing. And look at the theta decay of the contract you want to roll to, and then subtract that amount of time and add it to the credit you would get right now. And that's realistically a ballpark figure. So I was able to show you how I roll options. Hopefully you guys understand how this works, but quite simply, it's not always easy to just roll a contract that's pretty much decayed down to $1 or $2 or $5 and go out to a new week. When you're deep in the money, it takes patience and understanding of theta, time decay, and the aspect of time versus intrinsic and extrinsic value, which is why I showed you guys how you can take a deep in the money call on Robinhood at $17, which I was already going to be assigned on no matter what, and rolled it out 5 weeks and up to $17.50, collected more premium, and now if I get assigned, I'm making more money on both ends. Since I was already in a bad position, I just made that bad position a little juicier, and with more time, you can continue to do that until the stock pulls back, and then you keep rolling out, and within 3 to 4 months, you're making more premium, and now your strike price is above the stock price again. It is a long play, 2, 3, 4 months, depending on the stock or how volatile it is, and sometimes it won't work out though. Really, some stocks are not as juicy premium as others, which means you're going to end up losing your shares. So the best case scenario in that situation is to roll out 1, 2, 3 weeks and keep your strike the same, because then you're going to get assigned anyway. You might as well just collect a little bit more premium and just keep doing that, or until the stock recovers. So if you have a contract, $17 for example on Robinhood, and I'm getting ready to be assigned on that, if I go out 3 weeks, keep it at $17 and collect $50 juicy premium, I'm still going to get assigned, or the stock price is going to go down, but I'm making more money before I get assigned. I just took it one step further, went up to $17.50 and went out 3 more weeks and still almost collected $40. But you guys get the idea. Rolling options doesn't have to be difficult, but it is tricky, and it's not as simple as just buying to close an old contract that's out of the money and cheap and rolling it into a new contract to make more juicy premium. That's the easy part. But being able to roll options that are deep in the money and be able to save your stocks and continue to roll out and make more profits slowly but surely to recover your stocks and prevent them from being assigned is another whole level to this game. And if you do it correctly, you can continue to sell covered calls like you already were. However, you have more confidence now that if your call contract, your short position goes into the money, with time and patience, you can prevent the assignment from happening and eventually get back to making profits on covered calls. Thanks so much for being here, guys. I really appreciate you. If it's your first time, be sure to subscribe and tap the bell so you know when I post new videos. And if you can give me a thumbs up, it's greatly appreciated, as it greatly helps the channel grow. Don't forget, also, high five to everyone. We've been making some good premiums, some juicy premiums and profits over the last couple of weeks with Hims, Soundhound, Rivian, Upstart, Palantir, Lyft, Robinhood, and a few other stocks. If you guys want to be profitable and you guys want trade alerts, sign up for the free newsletter right there on the screen and in the information box below, because not only are you going to get tips and strategies and updated technicals and fundamentals right to your email, the first 100 people are going to get free trade alerts. That's right. And not only that, I am launching my full Discord and coaching course in about 2 weeks, limited space available. So if you guys are interested, sign up for the newsletter and reply to the autoresponder or email me directly, Corey@investwithcorey.com, and let me know you're interested, because I only have limited space, so you might miss out. And it could take several months to open up more positions. So if you guys are interested, you want to get in first, let me know. Well, don't be sad, guys. I know this video is over, but I picked another one that you're going to love just for you. And it's how I grew my wealth from 13,000 to over 7 figures after my divorce, and how trading changed my life. And that video is right here, right there. You guys are going to love it. I'll see you over there. This will tell you my whole journey and show you everything I went through, and it's going to open your eyes to the possibilities of trading and becoming profitable. Right there. I'll see you over there. Let's grow our wealth together. Take care, guys.